Dividend growth stocks increase your quality of life every year because your income increases every year. But what happens when a dividend champion stops increasing their dividend? Well, they're no longer a champion, so we kick them to the curb and move on. The soonest we'd take another look at a fallen champion is in 25 years, which is the amount of time it would take them to regain champion status again. But it's not always that simple to detect when a champion is falling or to even identify a fallen champion. Today, we're going to look back at 5 examples of dividend champions that fell from grace rather recently to see what we can learn. So how many total dividend champions are there? Well, in our recently released Q-score calculator, we have 79 champions in our core universe that we use to make up our own 30 stock DGI portfolio. We also have 43 small cap champions, 20 upcoming champions. That means they've increased their dividend for at least 20 years in a row or more. A champion has done that for 25 or more, a dividend king 50 or more, and 63 international champions. So we monitor all incoming and outgoing names from this universe. And today we're going to look at 5 exits from our core universe. Now, how do we know when an exit's going to happen? Well, usually it's already going to be on our radar because of a higher than usual yield. And this is where the value versus value trap question comes into play. I think VFC is a great example of a value trap, and we'll look at that. Whilst Exxon is a good example of value. When oil prices went negative because of the Rona, that actually happened to be a good time to add some shares of Exxon, which we did. Now, Ben is a company that, Franklin Templeton, is a company that's currently on probation. In other words, we're undecided whether or not that's a value or value trap, and we did a piece on asset managers that looked at that. But unusually high yields very suddenly are bad. And when you look at the track record of a dividend champion, quarterly dividends only tell you so much. This can get very tricky. We're interested in comparing fiscal year to fiscal year. That's how we determine a company has established their track record and that they maintain it. Now, these firms often speak vaguely when they cut their dividend. They'll say things like, well, the dividend's no longer in focus as we move to other things, or we're going to do a dividend reset. They don't usually say outright that they're cutting their dividend until it actually happens. So we often need to make decisions with some level of subjectivity. Now, most of the time, we're going to be out before the cut actually happens, and we're fortunate enough to have a second opinion if the firm happens to be in the S&P 500, because S&P Global, they track their own universe of champions in the S&P 500, which they call aristocrats. So that's a good second opinion. Now, the first company we're going to talk about today is Walgreens Boots Alliance. Now, if you're lucky, there's going to be a repeatable pattern in terms of how the company increases their dividend. Here you can see this for Walgreens Boots Alliance. In the second quarter of every year, they raise their dividend by, in all these cases, a rather small amount. That's important to note. Now, this was observed over the past decade. In other words, for the past 10 years, in the second quarter, every second quarter, they raised that dividend. Well, what happened is in 2023, the alarm was raised in July 2023 when that increase didn't happen. Now, had they cut their dividend? No. Had they stopped growing their dividend? No, because we compare fiscal year to fiscal year. So when they reached the end of 2023, that last quarter, technically they had increased their dividend because the delta between 2023 that you see here in the table and 2022 is about 5/100ths of a penny. Now, would we consider that a raise? No, because the amount is just too small and the writing was on the wall. So the next time they announced a dividend in 2024, they halved it and their track record was broken, though we would argue it was broken at the end of 2023 with that just minuscule raise. So the stock is since down 56% since this press release compared to an S&P 500 return of 42%. So exiting that champion turned out to be a good idea. Of course, it's not over until the big, beautiful woman sings, but it seems that Walgreens Boots is in a whole lot of trouble. Speculations abound around why that is. It's probably because Amazon ate their lunch. But leading up to that cut, you can see how growth was decelerating hard. That's a trend we're going to see among fallen champions as they try to retain that track record. And What happened with Walgreens Boots Alliance is that their ability to generate cash started falling, and the company saw that coming. And of course, if you don't have positive operating cash flows that are relatively strong, you can't pay your dividend and pay your debt at the same time. So when we consider today's 5 fallen angels, the majority are smaller companies. That's something to note in our own methodology. We reward size. So when you look at the categories here of sectors and industries, consumer discretionary, especially apparel and restaurants, are subject to the whims of fickle retail consumers. So this is one of the reasons why you don't see a lot of restaurants as dividend champions. McDonald's has really bucked that trend, and their ability to persist in terms of popularity over time is rather impressive. When it comes to fashion, clothes, things like that, these add no value to society, so it's no surprise there to see those fall out of favor. So perhaps when considering the consumer discretionary sector, when you're looking at dividend champions, you might want to keep those things in mind. Now, the biggest surprise here is probably 3M, because they were a conglomerate, and those are typically highly diversified and one would consider safe. The problem is that the attorneys got a hold of them. AT&T seemed to have the writing on the wall for the longest time. We'll talk about that. And UGI is a unique early warning case that we're going to discuss. So talking about AT&T, telecoms used to be great until they weren't. In November of 2017, GICS, that's the Global Industry Classification Standard, they renamed the telecommunications services sector to just communication services and changed that up quite a bit because the sector was becoming entirely irrelevant. Now, no dividend champions remain in that sector, just one upcoming champion called TELUS Corporation. So AT&T really lost their way when they were trying to reinvent themselves. And here you can see their pattern of increases, rather interesting. At the beginning of the year, they increase, and it appears to be by 1 penny. And what you can note about this is that even though they have this pattern, if they break it, you still can't say that they cut their dividend, their track record, until the entire year of 2021 is passed, because that last quarter, they could save the day by raising the dividend appropriately. But when we look at what actually happened here, we see that once they reached the end of 2021 and that dividend was still the same, then you had the exact same amount from 2021 to 2020. Seems like lots of champions will go the route where they have a year where things are the same, then they dump it. And that's exactly what happened here. You see that in 2022, they dumped that dividend nearly in half. And I like this commentary. It says, investors reacted poorly to the company's plan to unload Warner Media assets to Discovery for $43 billion. That's 3 years after they bought those assets for $102 billion. So just burning cash, a failed attempt at pivoting into relevance. And what happened is while they were trying to reinvent themselves, they raised a ton of debt. Here you can see their debt over time. Cash used to pay dividends oftentimes needs to be used to service debt. And that's what happened with VFC. It's also what happened with AT&T. And here you can see that consistently high yield over time, and it gradually was increasing higher and higher. There's no legend here for the time frame, but the pattern is what you should pay attention to. That dividend yield, of course, now is around 5% because the dividend halved. Otherwise, it would be 10%, right? So a high dividend yield that rises suddenly, or one that persists over time and keeps growing while the dividend is increasing very, very slowly, that's usually a sign that a cut is coming or dividend growth is going to be very, very minimal. If the choice to increase the dividend slowly is self-imposed, in other words, it's not forced because of financial constraints, then that's a different story. Walmart's an example of that. So they pulled back on dividend growth so they could invest in technology, and that seems to be working for them. And of course, that brought their Q score down in our own methodology. But we continue to hold that firm because we think that their strategy may just work out, and they seem to be resuming their growth, so all is good there. But go look at your portfolio of dividend growth stocks, see which ones offer the higher yields, and compare the current yield to historical yields over time. So here's some great examples. You have VFC along the top there. See that spike? And this is taken from a presentation we did on VFC before they lost their champion status. So we were pointing to that spike you see there as a big concern. Why is their dividend yield spiking that high? Exxon, we had an equal concern, except That was explainable because the commodity oil had hit negative prices and there was no way that was going to persist. So we saw that as a temporary condition and added some shares. That along the bottom, you see J&J there. And I like this because it shows how these firms will have a ceiling on yield sometimes, where that yield may go up, and this isn't that dramatic. I think it's around 3.5%. It's below 4%, and it will persist there for a while. This would have been from 2010 to about 2014, but then it goes back down. So it's a trend more so than a spike. So when it comes to VFC, I liked this report from Moody's. You see here, this was before they lost their champion status. Moody's changes VF Corp's outlook to negative. This was in October of 2022, citing some problems with their debt, among other things. And this is what we noted when we were looking at VFC's rather high yield. And here you can see the actual cut. So VFC had a track record of increasing their dividend in the last quarter of every year. And what happened here, this is interesting again, since the pattern was to increase it in the last quarter, for 2023, when they started out at 30 cents, you could say, well, that's okay. They could still increase it in the last quarter. And then they went 30 cents, 30 cents. And that last quarter, they would have had to increase it by 82 cents. In order to keep their track record. And you see, that's when the official cut happened, because they didn't do 30 cents, they didn't do 82 cents, they did 9 cents. And that's what it's been at going forward. So that's when they lost their status. So you would have had some warning ahead. And when you look at VFC's track record, again, that pattern of raising in the last quarter, again, we see minimal increases. It's like they're just trying to hang on to that status before they finally give up and let it go. Now, when we look at 3M, as I said, this is a company I was quite surprised to see lose their status. And look here, we see that the beginning of every year is when they increase their dividend, and they persist that. Again, what do we see here? Very small increases every year. Then what happened is that in 2024, the first quarter, they had their increase. You see $1.51, all appeared well. People were saying, they're keeping that increase. But then the following quarter, they halved that dividend. And that's when they lost their status. Now, this was a tricky situation because of the spinoff of Solventum. So they had key management changes. That's usually an indication that something major might happen. If you're going to do something major, that would be the time to do it. They had some clarity on the earplug litigation. So there's a real concern that I have over mass tort lawsuits, and you'll have to do this due diligence yourself. These are lawsuits that take place when the criteria for a class action isn't met, and there's some academic debate about whether these are very damaging to some of America's largest companies, or are these ambulance chasers really interested in the welfare of the common man. So you'll need to go down that path yourself, but this is a concern because you also see this happening with J&J, and who knows what other companies might be afflicted by these problems. So setting that aside, there was talk of a dividend reset following their spinoff, and they said, we're going to target 40% of adjusted free cash flow. You see this alert we sent our subscribers. It talks about how we just didn't see that this firm would be increasing their dividend, even post-spinout, that in fact they had lost their champion status, and the media confirmed that after unloading 25% of its revenue and earnings with that spinoff, 3M announced it would reset the dividend, which had increased annually for 64 years. So it lost its status. Now, what's interesting here is that whilst most champions, when they lose their status, you see stock prices decline. For 3M, the reverse happened, at least so far. And I think that's because the litigation risk was removed there, or at least it was quantified. Once 3M's no longer a champion, we just don't look back. Now, this is a very interesting slide, and it looks at the 3 early warnings we had for VFC, Walgreens Boots, and AT&T. So I put the date here of the early signal and then the actual cut. And the delta between those two dates, what the performance looks like. And you can see VFC sunk 39% during that period of time. Walgreens Boots 30% and T 11% compared to the benchmarks there for the S&P 500. When there's an early signal, it seems like a good idea to act upon it. Now, our methodology is very strict, and we don't cut companies until we're certain a cut is going to happen. But there are times when we may pay attention to these early warnings, and here's an example, a firm called UGI. So along the top here, you can see how their dividend actually hasn't decreased. However, what is it doing? It's gradually getting smaller and smaller. So it went there, from 17, 9%, 4%, then to 1% between 2024 and 2023. Here you can see something interesting. See how the quarterly dividend can persist the same for a long time, yet you can still have a fiscal year difference. So here you can see 2023, the dividend was 0.375 cents in the second quarter. That's persisted all the way until the fourth quarter of last year. And it can actually persist for 10 quarters in a row, for 3 more quarters the next year. And then that fourth quarter, they could raise it enough to keep the track record. So going back to what I said earlier, when you're looking at champion status, don't just look quarterly. You have to look at fiscal years. Now, if UGI hasn't stopped increasing their dividend yet, why are they a fallen dividend champion? Well, we spelled that out in this alert to our premium subscribers. It was quite good. I was confused myself as to why they were rejected, and I looked at this language from their CFO and CEO, and the writing is on the wall. It says, between fiscal 2024 and 2025, dividends will stay flat. They say, we're going to keep the amount flat through fiscal 2026, return to a long-term dividend growth rate of 4% in fiscal 2027. So here we're going to take management for their word. And what happens if they actually increase the dividend and they go back on that? Well, first of all, it shows they're incompetent. Second, it shows that they don't take this stuff very seriously. So to come to that conclusion and to tell the market that was very surprising. Why would you keep it flat when all you have to do is increase it by 1 penny, as the examples we showed you today of fallen dividend champions? Well, probably because they know that they won't be able to do that, because eventually they'll have to decrease their dividend. This is just not a good sign. All they had to do was raise it by a penny and everything would have been fine for 2 years. Maybe there's something else under the hood we're not seeing. So just going back to these 5 fallen champions, in layman's terms, AT&T was a victim of technological change. I mean, the entire telecom sector went away. A VFC didn't appropriately manage their debt load as they moved in and out of their portfolio of clothing companies. They made some bad M&A decisions. Walgreens boots had their asses handed to them by Amazon, and 3M had their asses handed to them by attorneys. And UGI's management team, they just seem incompetent. So 5 lessons we can take away from these 5 fallen champions. Consistent positive operating cash flows help ensure continued dividend increases. Excessive debt can pose problems. If a company has high levels of debt, they ought to be monitoring those key metrics, and you can pay attention to what the ratings agencies say about that. Sudden spiking yields in your portfolio usually signal a problem, and they're worth investigating. We pay attention to that stuff for our premium subscribers. Mass tort lawsuits spell a lot of trouble. J&J has managed to avert their own crisis, it seems, but that's something to pay attention to going forward. Now, anticipating cuts appears to be useful to get ahead of the share price drop, and our methodology stays the same going forward. We only exit a stock if the dividend stops growing and we're certain that it's not going to continue growing. But today certainly posed some interesting use cases, and we may do further research on this in the future. I'm going to go ahead and leave you with a piece on building your own great dividend portfolio. This is a strategy we have most of our assets in. I've spent over a decade developing it. Give that a watch. Thanks so much for taking the time to watch this today.